Inventory is finally rising. Hi, I'm back with another article from Housing Wire. I'm Ken Blumberg, your All-American Realtor, and today we're going to look at the rising inventory levels throughout the nation. We can now say the housing market spring selling season is finally underway. Since 2020, the seasonal bottom of the housing inventory has arrived several months later than normal, making it more complicated to track housing inventory data. Still, we have some promising signs that we might have finally hit inventory bottom for 2023. We didn't see too much volatility in mortgage rates last week, but purchase applications declined in reaction to rates rising 2 weeks ago. So here's a quick rundown of last week. Active listings rose 8,546. Keeping the tradition of higher rates impacting this weekly date negatively intact. Mortgage rates started the week off at 6.61% and ended at 6.66%, so a calm week for mortgage rates. So the article looks at weekly housing inventory. Looking at Altos research data from 2 weeks ago, the first thing that popped into my mind when active listings fell and new listing data fell, that we could have had an Easter holiday impact at that time. If that is the case, then this week's gain in active inventory and new listings needs to be taken with a grain of salt until we get next week's data. My bias is wanting to see active and new listing data grow, so I have to check myself when I see positive housing inventory data that might need more confirmation. Since 2020, the seasonal inventory bump has happened later than usual, not until March or April. Since 2020 has been working at all-time lows. Purchase application data growth late in the year has pushed out the seasonal bottom from the following year. I hope the seasonal bottom was 2 weeks ago. It's springtime, and we have always had a traditional spring increase in housing inventory. It would not be a healthy sign if we did not get active listings to grow now. Weekly inventory change, April 14 to 21. Inventory rose from approximately 405,000 homes to 414,000, approximately bringing 9,000 additional homes to market. For the same week of last year, from April 15th to April 22nd, inventory rose from about 267,000 to 271,000, giving us about 143,000 additional homes year over year. The peak inventory levels for 2023 so far is 473,000 homes approximately. For context, active listings for this week in 2015 were 1,059,000 homes approximately. So you can see on this inventory chart that inventory is just starting to bump up.
Wow.
And I'm recording this video as of the 1st of May. New listing data hasn't recovered since last year's big mortgage rate spike, and we have been trending at all-time lows in 2023. However, this week we saw good week-to-week growth, and the new listing data for this calendar week isn't too far off from what we saw in 2022. Again, he says he's a bit mindful because of Easter, but he will take what he can get. And I agree that at this point, more inventory is definitely a good thing. And personally, I think that these ultra low inventory levels that we are seeing is the result of the very low interest rates people received from 2020 to 2022. So number one, most people can still afford their mortgages. And number two, it's costing them way too much to move up into a bigger home. So the traditional pattern of moving up to the next level home after 5 to 7 years of building your equity has been stalled because of the low interest rates people received. And now the interest rates are double from what they were last year. So for a little historical perspective, in 2021, we had about 69,000 listings. In 2022, there was about 60,000 listings. In 2023, there's right about 60,000 new listings. So to put that in perspective, for years prior than the pandemic, when interest rates were more in the normal territory, in 2015, we had about 89,000 new listings. 2016, it was about 95,000. In 2017, we had about 78,000 new listings. So as you can see from the chart below, new listing data is highly seasonal, so we don't have much time left before the seasonal decline in the data line. So for those that are looking for a housing crash, I'm going to give you a little bit more historical perspective, and this is just based on my own research. In 2010 alone, there was about 2.9 million foreclosures. This year, we're only expecting to see about 100,000 foreclosures. Now, while last year we had about 6 million homes change hands, we don't have nearly the amount of forced sellers due to foreclosure that we saw in 2010. So even though prices have decreased from the peak of last year, it does not appear that we are going to see a drastic decline in home prices anytime soon. Now, as we know, bank failures are rippling through the economy. There is a massive crash in the commercial real estate sector happening as we speak, and unemployment is starting to go up. And many tech companies, along with many retailers, are announcing layoff after layoff. So we will see how this evolves over the next several months into next year. And again, so looking back at 2007 to the great financial crisis and the mortgage crisis that we saw, even though we had approximately a little over 4 million homes that sold, and we are trending at the same sales volume as 2007, we are only at about 980,000 total active listings per the last existing home sales report. On the monthly supply for existing homes, I know stock traders and YouTube people are notorious comparing to everything in 2008. Below is the monthly supply of existing homes from 1999 to 2014, where you can clearly see the growth of monthly supply from 2006 to 2011. The red line is where NAR believes a balanced market is at 6 months of supply. The author believes the number is 4 months. Either way, today's monthly supply of 2.6 months shows how far away we are from the 2008 housing economics. Contrast that chart above, which is NAR monthly supply data from 1999 to 2014, with the chart below, which is NAR's monthly supply data from 2013 to 2023. So as you can see in the chart below, the monthly supply data shows we have no forced selling action in the housing market today, unlike we did in the 2006 to 2011 period. So the article goes on to talk about the 10-year yield and mortgage rates. Last week, mortgage rates didn't move much, even though the jobless claim data is getting softer, despite the chief economists at the conference board stating on CNBC last week that they believe the recession has already started. We didn't see too much action on the 10-year yield and rates. So the author goes on to say that he's keeping a very close eye on the 10-year yield because it is closely correlated with interest rate. Because when an investor has to choose where they are going to put their money, whether it's going to be in an investment property or a 10-year government bond, those rates tend to fluctuate together to try to balance out where people are going to invest their money. So the author goes on and says in his 2023 forecast, he said that if the economy stays firm, the 10-year rate should be between about 3.21% and 4.25%, equating to 5.75 to 7.25% mortgage rates. If the economy gets weaker and we see a noticeable rise in jobless claims, the 10-year yield should go as low as 2.73%, translating to 5.25% mortgage rates. And as I mentioned before, it seems like things in the economy are unraveling at an unnerving pace. So the author goes on to say that he's watching jobless claims because the Fed will pivot its language on the economy once jobless claims get over 323,000 on a 4-week moving average. However, we are still far from those levels, even though it has risen recently. Last week, initial jobless claims increased by 11,000, and the 4-week moving average rose to 239,750. So the article goes on to say purchase application data has been a bright spot as far as the housing data. In 2022, home sales collapsed in a waterfall fashion. However, starting on November 9, 2022, purchase application data began to improve, and that improvement has created stabilization in the sales data in 2023. Since November 9th, including some holiday weekends, we had seen 15 positive to 6 negative purchase application prints. This year, we have had 8 positive versus 6 negative prints. This index is very sensitive. For the most part, the mortgage rates have risen this year, and we have seen this index fall week to week. And that is what we saw last week as the index fell down 10%. week to week and down 36% year over year. And as the chart below shows, we have a shallow bar in this data line since the crash of 2022. That he is saying, do not look at this data line as a V-shaped recovery that we saw during the COVID-19 pandemic, but just a stabilization and growth from a low bar. So he says that he weighs this index from the second week of January to the first week of May, and after May, the volume always falls. So he says if the economy gets weaker later in the year and mortgage rates fall at that time, we'll need to focus more on the purchase application data. The last few years have seen positive purchase applications number in the fall and winter, and we can make a case for that happening again if mortgage rates break below 6% this year. So he goes on to say that we have 4 critical housing reports coming in the weeks ahead. So on Tuesday, we have a new home sales report, the lagging S&P CoreLogic Case-Shiller home price report, and the FHFA home price index. Of course, we all know that pricing data has firmed up as the housing economic story of the second half of 2022 has changed this year. Keeping things simple, the demand has stabilized and the active listings are historically low. For the builders, their stocks have been on fire, which has driven some short stock traders mad. However, I want to see what their active monthly supply data looks like now. The key for me is getting monthly supply below 6.5 months while housing completions are still rising, which is good. We haven't had growth in the housing permits, which is key for getting housing out of the recession, the author states. We also have a pending housing sales report on Thursday, which already had a big bounce from its lows. It gets harder to keep the bounce going if purchase applications don't show more growth. We also have to remember that almost 30% of homes are still bought with cash. So housing demand doesn't need to be 100% driven by mortgaged buyers. So he goes on to say that, again, he's going to keep a close eye on the jobless claims. In the next couple of days, I'm going to bring you a very interesting article about Phoenix and about Las Vegas, talking about how rents are going down pretty significantly and how that can also affect buyer demand in Las Vegas, Phoenix, and the surrounding areas. So stay tuned for more real estate news. I hope you liked the information in this article. If you did, give me a thumbs up, like, comment, and subscribe. What do you think is going to happen in the housing market? Again, are homeowners going to be able to hold on to those cheap mortgages, or is there going to be a cataclysmic failure in the job market due to the fact that the Federal Reserve continues to raise interest rates, making money more expensive so companies are not able to invest in their businesses and continue to pay their employees and are going to need to start laying off en masse? Go ahead and comment and tell me what you think. Thanks for watching, and I'll see you on the next video.